What's going on, guys? It's Tickers and Tokens here, back with another video. In today's video, guys, I want to talk to you about the earnings season we got coming up this week, man. Oh, man. A lot of the big earning caps like Apple, Amazon, Meta, Google, Microsoft, all the big cap tech stocks, man, are just reporting this week, man. These are some of the biggest companies on the planet, man, and this is going to be a crazy week one way or the other. We're going to watch this video and respond to it and hear what they got to say about the earnings this week.
Really since maybe Friday, seeing a little bit of a decoupling between the bond market and the equity market?
We've been here before. We've been here, in fact, multiple times this year where the market gets very optimistic about what the Fed might do. But
something I've noticed too myself is that you see this a lot. I said this in my last video too. Is every time we get into like this big aggressive rate hike, we always see the markets come in like, oh no, they're gonna cut these rates. They gotta get rid of them. Oh, like they were too aggressive last time. Surely they're gonna see that. Oh, these rates are too high here. Oh, look at the consumer demand low over here. Look over there. Look at this. Look at that. All these reasons the Fed's got to lower their interest rates. But the main reason they have these interest rates is inflation. Turns out inflation hasn't really budged all that much. Has not budged at all. It's come down maybe a little bit since like the June highs and stuff, but other than that, no, man, it's still pretty much the same. It's crazy, man.
we have to wait and see how the data plays out because we do have another inflation report coming up. We do have another jobs report coming up before we think about what the Fed might do in December. Broadly, we're thinking that the Fed goes 75 basis points.
Yeah, the labor market comes out stronger than I expect to. Then you can see Jerome Powell could have more reason to be aggressive. And a normal economy having great jobs reports and low unemployment would be a fantastic thing, but not here.
November. Right now, it's a real toss-up as to whether they go 50 or 75 in December, but it's a little bit too early to tell.
Given how aggressive Powell's been, though, I'm thinking of 75 for sure. 75 sounds like it's right. They've done it 75 for the past 3 times now. It will be the first time the Fed's ever done 75 basis points in a single consecutive run. So maybe they're looking to set new records here. Go Jerome Powell, right?
Tell right now. So we still want to be a little bit cautious in our approach to markets and not extrapolate too much from some of the price action we've seen over the last day or two.
Okay, so the calm before the storm. Brent, how do you see this market right now as we have, a third of the S&P raced or poised to report this week?
Yeah, I mean, I think you're seeing
a third of the S&P. I'm sure they're talking about just market cap, but I think something like 160 stocks are reporting this week, man. But all the major caps are reporting this week. It's you can see a lot of movement in the market, a lot of money changing hands one way or the other, buying or selling. It's going to be some pressure for sure.
Seeing some of the earnings positivity reflected in stock markets right now. And I think we're all hopefully starting to realize that the stickiness in inflation is being caused by shelter prices, which come into the data 12-month lag. Current shelter prices are beginning to moderate. Housing prices are moderating, and that will bring down inflation.
Yeah, if you're seeing actually how home prices in some places are even starting to come down massively. I was watching Keenan's video earlier. He was talking about how a house had come down to like 400-something thousand in Los Angeles, and I was like, "Wow, you can actually get a house for that? You can get anything other than a cardboard box stapled to the sidewalk for 400,000." Oh man, in LA, oh yeah, that's a good sign that prices are starting to come back down. But I know along with that comes higher unemployment. So I know there's a lot of people going to be losing their jobs out there. It's going to be a sad time, man.
Inflation with the good side, which is actually moderating also. Something I hear no one talking about, spot commodity prices are flat year over year. And so if you think about that.
Kathy brought this up. Kathy Wood, yeah. You listen to Kathy. She's been calling the peak on gold for almost a year now. She was talking about how it peaked in 2020. Gold and copper had peaked a long time ago, and they've been on a downtrend for quite some time. So we're definitely heading for a recession. If we're not already in one, I think we're already in one. But you're starting to see that people are starting to not spend as much money as they used to. A weakening consumer, and you've already seen the demand for a lot of the precious metals already go down. So. There's one person, Kathy Wood's already brought it up. Shout out to Kathy Wood for being for.
I think you're going to see inflation begin to fall. I think the Federal Reserve is in the last innings of tightening, and I think better days are ahead for both the bond and the stock market.
Okay, I want to dig into that a little bit more, but first, Mira, I mean, given the fact that We do have some uncertainties, at least in the near term here, ahead of that Fed meeting next week, as we do start to get more details out of earnings season, et cetera. How do you position yourself as an investor?
I think more than anything in this environment, we want to be diversified, not too defensive. Because if we think about walking that line between
You want to be diversified, but not too defensive. But and like I wanted diversification to be defensive. I'll tell you right now, I'm just heavy on tech stocks, man, just because they've been destroyed this year. So they're looking pretty more attractive day by day by day. I know they're red, they're beaten down, but these are fantastic companies that are going to do well over the long term. Just my opinion, I'm heavy on tech stocks, and I probably always will be. That's just my style of investing. I don't know, maybe y'all have a different way, but that's just my opinion.
being cautious and overly conservative, what we're seeing in a lot of the traditional defensive areas is some risk. So, for example, we've seen treasuries rise from 2.6% just back in August to 4.2% today. So that rising yields is a risk. When we think about gold and what you could be getting in the very
Take a look and note that the yields are flattening on the treasuries here. They're all just pretty much about the same number. If you're in for a long time now, it was actually inverted. So you're seeing those short terms actually starting to lose value, and the longer terms starting to pick up value again. So we're definitely things are going to trend better in the next coming months, but expect a lot of pain until then. We're definitely going into a recession. You might see the housing market dip a little bit. All interest rates are going to keep putting demand on mortgages, and people aren't going to be able to pay off those mortgages if their home price is already high too. So again, it's going to get ugly before it gets better.
very shorter term, short duration areas of the market, or even cash from a yield perspective, that is a lost opportunity cost there. And look at areas that are more defensive in the market traditionally, like staples, like utilities, and how high they're priced right now. I think that what we have to think about is not making any big bets, really being diversified across the board, as opposed to trying to stick to a defensive playbook that might not work the same in a higher inflation, higher rate environment with the type of uncertainty we're seeing.
Yeah. So, Brent, if the worst of the
I'd say your best bet is just go with stocks you want to buy, because I mean, ain't nothing safe in a recession, y'all. I'm just gonna be honest with you. I don't care if you're in gold. I don't care if you're in Bitcoin. I don't care if you're in stocks. I don't care if you're, unless you're just straight up in pure cash, man. Everything's gonna get hit, and inflation's gonna hit your money anyway. So, my best bet is just go ahead and buy cheap assets that you really love and really want to hold for the long term, and just ignores a lot of this volatility, because you need to have a long term mindset anyway with this kind of stuff. You really need to be an investor. Now, you can be a trader too. But, I want you to be an investor. I want you to be an investor who trades, not a trader who invests. If you follow me on that one.
The pain is potentially behind us, which is what I think I'm hearing out of you. Then what would you be buying into right now?
Sure. So we want to be in the cheapest parts of the market, something we've been consistently saying for the last year or so. You want to be in U.S. mid caps and small caps, which trade at 11, 12.
Oh man, mid and small caps, man, have just been devastated. They have like a 2 or 3x just reversion to mean, man. Like a lot of these stocks are trading for P's of like 3, 4, and 5, when historically they trade for average like 15, 16, 17. So they're easy 2, 3, 4, 5x's depending on the stock, man. And that's assuming no growth in them at all, like just returning back to a fair value. Like we're talking about small caps, so of course they're going to grow. And a few of the small caps I like to watch are SoFi, Palantir, and I got like Ally Financial for my financial one. So shout out to anybody watching SoFi and Palantir out there. I love them stocks, man. But let's continue the video.
12 times earnings. And so you have that margin of safety against the potential for falling earnings in the future. And if you think about the opposite side of that, these are the areas that will do well also. I mean, sector neutral value is trading at 8 times earnings. And if you think about your opening, the Barclays Aggregate Bond Index now offers 5.15%. That was 175 in the beginning of the year. So I agree with the diversified commentary, and I think just focusing more on extending duration just a bit on the bond side and focusing on those cheap parts of the market that I referenced.
Yep. Right now, tech stocks are cheap compared to what they were. So that's definitely good to keep in mind. Like keep looking for these value stocks and low multiple growth stocks. Man, they're going to pay you very well in the future once they reach their massive earnings. But that's pretty much all I really want to talk to you about today, guys. Just make sure you're out here getting these good stocks, because the market's going to be volatile, especially with the earnings coming this week. We got a lot of companies reporting, like Apple and Amazon, Meta and Google. Oh man, and UPS is going to be sharing their guidance when we already seen how FedEx has already gave theirs, and it was rough, man. It was pretty rough. Um, if you like the video, guys, go ahead and hit like and subscribe, and I'll be back for another video here soon, maybe later on tonight, maybe tomorrow, and I haven't decided the topic yet. So if you want to suggest me a video topic, you can suggest one down in the comments below. And this has been Tiggers and Tokens, and I'll catch you guys in the next one. Take care.